Joining me now for a deeper dive into the markets is Nesi Chetty from Stanlib. Nesi, thanks so much for your time this afternoon. So, as mentioned, sentiment seems to be turning around as markets stage a rebound. What's fueling this risk on mood? Is it on the back of China's growth plans? Is it these reports that Trump will relax those tariffs on Canada and Mexico?
Yeah, good day, Intarling, to you and your viewers. Look, there's a lot of things driving markets, I guess, at the moment. You would have seen at the start of the week, I mean, a lot of the news was centered on tariffs and particularly retaliatory tariffs from other countries. Now, we saw overnight, I guess, President Trump's speech to Congress, and there was, I guess, mixed reviews from the Democrats on that outlook. But Trump basically acknowledged that there may be an adjustment period as the tariffs take effect. So, although he defended his push to remake the U.S. economy, he's still declaring that momentum will be coming back. I mean, it wasn't surprising that he reiterated his threats to impose 25% tariffs on big commodities like aluminum and steel. But I think markets took comfort from maybe Commerce Secretary Howard Lutnick's comments that the administration might announce a pathway for tariff relief for goods from Mexico and Canada that may be a bit different. And remember, those are the two countries that were hardest hit, I guess, by some of the tariff news. I guess you also have to add to that. I mean, we had a very poor reading on consumer confidence in the U.S. And we saw a sell-off maybe at the start of the week. But there are still concerns that the economy might be slowing down faster than the Fed is willing to react, which I guess is a fairly tough situation for the U.S.
Let's move over to some company news. It's been, busy morning here on the local front, starting off with Woolies out with numbers. That apparel business really taking the shine away from the food business. And I mean, the group has been dealing with issues at its clothing business for years now. And it's not just in South Africa. We're seeing this play out in Australia as well. They just don't seem to be getting things right, Nesi. And I wonder if, they're just kicking at a dead horse at this point.
Yeah, look, if I look at the results, I mean, the food had a very good performance. So you look at turnover on a consolidated basis, up 5.7%. So, I mean, without a doubt, still strong, good growth from their food business.
Yeah.
So food was up 11%. And if you do the like for like, up 7 as well. So they're seeing positive volume momentum in that business. Their GP margins were up 30 bips to 24.9%. But I mean, all of that hard work was offset, I guess, by lower contributions by the apparel business and discretionary spend. I guess if I look at it, where we are at the point in the cycle, still tough in that segment of the market. If you look at other parts, I mean, beauty, fashion, and country road, they're in the midst of a transformation. They're implementing new processes and systems there would have impacted, I guess, their distribution centers. The Woolies Financial Services book, which is effectively, I mean, the sales that they generate from credit, that book decreased by 3.7%. But increased, I guess, 1% when you look at the legal side of the book. The impairment rate for the period, I mean, it was 5.4%, so slightly down from the 6.3% prior. But I guess the share is down 3% at midday to 55, because if one looks at the outlook statement, they're still worried about, I guess, a positive cyclical recovery in consumer spend. Australia, there are some signs that GDP is starting to recover, which will maybe aid the David Jones recovery, but still warning that, I mean, U.S. global trade relations, depending on how it pans out, could have an impact in their future results.
Let's move over to Curro. They've reported a 13% jump in HEPS, this mainly being boosted by an increase in tuition fee revenue. But we are seeing, student growth really muted on that front. And I guess that's just a reflection of the economic pressures households are under, right?
Yeah, so fairly mixed, I guess, if we call it a report card from Curro. So, I mean, the revenue was up 8%, and their recurring headline earnings also up 10%. So, a good showing over those two metrics. But, I mean, if one looks at tuition fee revenue, which is a good proxy of what the top line growth is, I mean, that's been inflationary at 7%. They have added learners over the period by about 1%. So, they're up to about 72,600 plus learners. But I guess the environment is it's becoming harder to add more and more learners. They are growing the Kuro schooling base by additional three schools. I mean, they're opening up in Walvis Bay, Namibia, and in Sandton and Barlow World as one. One must understand a business like this. I mean, their biggest cost is staff costs, and those are growing around 6%. So it gives you an idea on the impact on earnings if the top line is growing at 7 and the biggest cost is growing at 6. Notwithstanding that, I mean, they've been able to collect a bigger portion of fees. There has been a lot of improvement on the balance sheet. Balance sheet is very strong. And they've done the right things over the period. I mean, they bought about 120 million of shares in the market, and they'll continue to do more share buybacks the next 12 months. The share was up some 1% today.
All right, let's just hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
I am picking a share listed in London, Zanati, and whenever I buy or pick international shares, it's always useful to think, isn't there a business model in South Africa that I might be more comfortable with and might know that is similar? So the company is called Rightmove, and it's a similar business model to privateproperty.co.za in South Africa. It's an online platform. We spoke about platforms earlier.
Yeah.
The thing about a platform is you need to be dominant. And once you are dominant, you can make a lot of money as a platform. Now, Rightmove is the dominant online property platform in the UK. If anyone's looking for property, it's the first website they go to, dominant market share. They connect buyers and sellers of property. They obviously have got fees, whether it's a brokerage fee or a listing fee or all kinds of fees. They have moved into mortgages as well, take a mortgage origination fee. And a Australian group, the RIA Group, owned by Rupert Murdoch, actually tried to buy them a few months ago, but were rebuffed. And Rightmove came out with very good results last week. So they are chugging along, and I wouldn't be surprised if RIA Group tries again to do something here. But in the meantime, you're getting very high returns, nice growth, a dominant platform, and hard currency earnings from a South African perspective. So that's why Rightmove is my pick tonight.
I'm choosing Absa tonight. So we saw Nedbank reporting today a nice set of results, credit losses coming down, and that is going to be very positive if Absa can show the same, which we think that they will. This set of numbers, earnings growth expecting 4%, but I think from here Absa has the ability to grow closer to 9, even 10% a year. Plus you're getting an 8% dividend yield, so that's a 17-18% return. And I think that Absa has a lot of opportunity if they can get the right team in there. The business can be improved. There's a lot that they can learn from their peer group and what they've done in the apps that Capitec have rolled out, and even the app that Nedbank has. Absa can also do a similar thing. They just need the guys to catch the vision, and hopefully that the new CEO, which appointment which we're not expecting now, but will come maybe later this year, will be someone who can take the group and really deliver on the opportunity that they have.
So Absa and London listed Rightmove. Nesi, just a quick take from you on those counters.
Yeah, so I guess, I mean, one's in that property space, and it's similar type of growth. I mean, they're dominant, and it is a platform business. So one can understand that over time that it's quite scalable if they get the volume and interest on that. I guess if you look at my stock pick, which is Sirius Real Estate, I mean, it's a leading owner and operator of business parks, offices and mixed-use workspaces. I mean, they listed in SA. They do have a UK listing as well, but it's a sizable property portfolio. I mean, it's 2.3 billion euros of assets, but by and large, the bulk of assets are scattered across Germany at about 1.8 billion. They have a very nice UK business in BizHub, which they've acquired, but it's a scalable business. They've got a dominant platform. They've come up on their 10-year anniversary on the JSE, and what we like about Sirius, if we look at the selection or split of assets, I mean, it's a third in storage, another third that sits in quasi offices, and then there's an element that's production and smart space where they're able to do clever and innovative things where they're buying assets and able to get the rental uplift. occupancies in those two businesses, particularly in Germany, is now sitting at 84%, and the UK is high at 86%. They're very conservatively valued assets in Sirius, so the German assets are about 6.8% net yield, while UK is higher in 9%. And look, if we look at the macro environment, I mean, the strength of the operating environment on the German platform, it continues to drive above inflationary rent growth, despite, I mean, the negative economic news that we've seen. The UK acquisitions have grown. I mean, UK has grown mostly through acquisitions, but there's future value creation in some of those underlying assets. If we look at the funding on those assets in Sirius Real Estate, they've done well to go and raise a 350 million corporate bond at a low coupon of 4% and fund it on a 7-year term. So this is a business where we look at the growth. We think it'll come between organic and a bit of acquisitions through time, with them being able to drive double-digit revenue. They've set a target of about 150 million euros in terms of funds from operations, and we think they'll be able to achieve that quite easily. There's very attractive forward valuation. So if we look at it on a euro basis, it's around a 10.7% DIPS yield. They do pay out 68% as a payout, so it's a very nice 7.5% forward yield and at a discount to NAV. So I guess it's got very similar and strong metrics relative to the other peers. All
right, Nesi, thanks so much for your time and sharing your insights this afternoon. That was Nesi Chetty from Stanlib.